Hey guys, how are you doing? It's Rohan here. So the USA Consumer Price Index decreased by 0.1% from the previous month, the largest drop since April 2020. Although there was a dip in CPI, it has still grown by 6.5% from a year ago, indicating that the rising cost of living continues to take a toll on US households, but don't have the expectation that Fed will go soft on interest rate tightening yet. And if we have not met before, in this channel you will find me every day analyzing my investment thesis and global macroeconomic issues. So don't forget to hit the subscribe button. When food and energy costs are removed from the equation, that is, the core consumer price index fell to 5.7% from 6% in November 2022 on yearly basis. On a monthly basis, core inflation increased by 0.3%. Now, a quick note on the basics. The Federal Reserve primarily utilizes interest rates to manage inflation. When inflation accelerates too quickly, the central bank will raise interest rates. If the economic demand or the price are too slow, then reduces the interest rates to stimulate growth. Now, it was becoming increasingly assumed by many that high inflation was a permanent factor in the US, yet the current evidence is indicating that most of the inflation from 2021 to the first half of 2022 could be short-lived, just as the Federal Reserve initially speculated. This does not mean that the inflation issue is completely resolved, because it is still way too above their 2% target. Now, the Fed's original outlook may not have been accurate, as it was their decision to raise interest rates to combat inflation that has resulted in some price decreasing, particularly real estate. And to that note, the Federal Reserve has claimed it is too early to consider reducing interest rates this year, and investors are becoming more confident that is precisely what the central bank will do. So, the contrast between the expectation of traders and the Fed's policy is becoming a major focal point for the financial market in 2023. Many financial managers assume that inflation has attained its peak and that price hikes will reduce significantly, causing the Federal Reserve to take back some of the interest rate increases by the end of the year, like it did in 2019, just 7 months after the last previous rate increase. Overall, the US inflation soared to 9.1% in June 2022, a record high in the past 41 years due to an upsurge in energy prices that began when the world started to reopen from the coronavirus pandemic in 2020 and further intensified because of Russia's invasion of Ukraine in February 22. But according to AAA, the cost of gasoline, which was around $5 per gallon in June 2022, is now back to $3.27. This is a major factor behind the 6.5% inflation rate now. The cost of durable items, especially cars, rose drastically as people spent money freely during the lockdown. However, now that the virus is increasingly under control and the part shortages is being solved, the demand for such commodities has reduced. Used car prices have been on the decline since July, and new car prices dropped in December. This has helped lower core inflation, which does not involve food and energy, to 5.7% from 6.6% in September. The COVID-19 pandemic and ultra-low interest rates resulted in surge in the acquisition of bigger homes and properties located in different areas. On the other hand, developers encountered problems with lack of raw materials, land, and employees. Now, energy, vehicles, and housing share a similarity in terms of strong demand and scarce supply. When buyers are willing to pay high prices, cost can skyrocket. This was witnessed with European governments paying a premium for natural gas, rental corporation paying high prices for used cars, and migrants from US coastline paying for residences in interior markets. It looked like the whole economy was utilizing the surge pricing system used by ride-sharing companies. But this kind of dynamics don't sustain. Either demand disintegrates or supply gets adjusted, or both can occur, which actually happened in all these markets to different extent. House prices have started to decline while the growth of new rents has decelerated. And after all those kind of transient factors are removed, what remains is the fundamental inflation rate, which theoretically can remain elevated only if the demand for goods and services continue to exceed the supply, or if the public anticipate higher inflation and adjust cost and wages accordingly. And also for all those kind of transient factors, one concern I see for investors now is that inflation number itself has become more complex. Most investors now look first at the monthly fluctuations in the core consumer price index, which removes foods and energy categories, to give a better picture of the long-term inflation rate. The prices of core goods have experienced a decline in recent times, which is attributed to increased availability of a variety of products and reduced need for them. Nonetheless, services inflation has stayed high, possibly owing to intensely competitive labor market and subsequent rise in labor costs. And the Federal Reserve considers wages as a major driver of prices related to services, and the Fed is worried about wages because the labor market is extremely tight. The unemployment rate ended 2022 at a 53-year low of 3.5%, which is way lower than the Fed's long-term forecast of 4%. The ratio of job openings to unemployed workers was 1.7 in November, surpassing the pre-pandemic peak of 1.2. Basically, that means that for every unemployed person, there are 1.7 jobs available. The Fed chairman, Mr. Powell, has been successful in convincing many investors that the job market is the most significant indicator of inflation, making the inflation data itself less critical. Now, some of these confusion related to the wages could be clarified when the Department of Labor discloses its quarterly employment cost index, which is widely seen as a reliable gauge of workers' remuneration. But I still would question the Federal Reserve's rationale that a competitive labor market will necessarily lead to a perpetual increase in services inflation. Look at another data point. Despite the tight labor market, there has not been a corresponding acceleration in wage growth. This is contrary to what would be expected if unemployment remained below its long-term rate. Data from December and revisions to preceding months demonstrate that hourly wage growth was decelerated in the course of the year. The 12-month variation decreased from 5.6% in March to 4.6% in December. In the last 3 months of the year, wages increased at a rate of 4.1% annually, which is a bit higher than the rate compatible with a 2% inflation, but not significantly. Nevertheless, according to independent analyst Mr. Omar Sharif, president of research firm Inflation Insight LLC, one factor behind high service inflation last year was a surge in airline fares, partly because of increased fuel cost. So Mr. Sharif's own preferred measure of services inflation strips out not only energy and housing categories, but also medical care and transportation. That gauge has shown less alarming trend in the rate of price increases. Now, coming back to my thesis that don't expect Fed to go soft on interest rate tightening, even if the increase in wages and prices is only transitory, that may not necessarily be reassuring to the Federal Reserve. When the term transitory was first introduced in March 2021, the rate of unemployment was 6%. And people were predicting a 3% rate of inflation for the following year. Those factors that govern inflation, such as the balance of supply and demand and the public's outlook, used to point to a positive outlook back then. This is no longer the case now, as unemployment is super low at 3.5% and people anticipate an inflation rate of 4.6% in the year ahead. This is the reason that Federal Reserve cannot yet signal the end of interest rate hikes, and also the possibility of a recession cannot be overlooked. Still, in contrast to a few months ago, the arguments for the Fed to be stringent is a bit weaker, and the possibility of a soft landing has actually increased. That pretty much wraps up this video. If you liked it, do smash the like button, and also don't forget to subscribe. See you in the next one.